Hey guys, how's it going? And I just want to talk today about a good business that I own, and I think it's going to do really well in the future, and it's called Lifeway, ticker symbol LWAY. So it's a microcap, has under 200 million market cap, but it has some consistent growth and opportunity, and it's a very, established company. It's been around for a while, and they've matured, and they're still producing growth, and so I think there's a lot of potential in the valuation here. So I just want to go over the business a little bit. So yeah, if you can just look at the stock chart over the last year, you can see it's performed, the last 5 years very well. It's tripled, and in the last year especially, it's almost doubled. We had a big run up to around $28, and then it came down. The valuation got stretched, in my opinion, and that's what you see with this big pullback. There's nothing really with the fundamentals that's wrong. It's just, it was overvalued from a fundamentals point of view, in my opinion. So just talking a little bit about the business, right? Lifeway makes a lot of different things. Their main product is kefir. They have European-style soft cheeses, cream, yogurt, some different probiotic type drinks for children, and they have some other dairy products. And you can see right here from the chart that I have pulled up, 82% of their sales are from that drinkable kefir. They have another minuscule portion with the cheeses and all that stuff, and you can see relatively good growth from the kefir segment from 2023. That's over 20%, so very nice revenue growth and sales growth in the kefir department. You can see that you could say this as a con or a pro, but two of their major customers account for a quarter of the net sales in 2024 and 2023. So looking at their balance sheet, it's really nice, really good. Nothing too out of the ordinary over here, but it's very strong. You have net sales 44 million. Of that, their gross profit 11.5 million. So we have a decent for a food business, for a physical product that's going on the shelves in different grocery stores. We have a very good gross profit margin over there. OPEX is relatively low considering the business they're in, and they're net income positive. They're also free cash flow positive, so that's very good. And you can see from the bottom, they're not diluting shareholders too much, and I'll go over the stock-based compensation in a little bit, but they're not diluting to raise money because they got a healthy balance sheet. So this is very good. Yeah, and just I wanted to show you over here. So I forgot to mention the total assets are greater than the total liabilities. They got a good amount of cash. Not worried whatsoever about that. I'm not showing it over here, but in the terms of the debt department, very strong. So net income, tripled over the last year, and this is due to the fact that Lifeway has been increasing their gross margin. Over the last, I believe, 10 to 12 quarters, it's just been consistently going up. Their revenues have also consistently gone up in the last several quarters, and it's nothing crazy. The last, year over year, we're up 16%, which is a very, very good double-digit revenue. But in general, we're talking about a mid-single-digit, high single-digit growth business CAGR. So that's very solid for this type of, product, because this is a tangible product that's going into the grocery store. So it's very rare to see, high double-digit growth that you see in a lot of software companies or something like Celsius, which is kind of a misnomer. But the net income has tripled. They have a lot more inventories now, and the reason that inventory position has tripled, you see the 339 million to the 974 million, is because their kefir products are really getting recognized. A lot of people recognize the probiotic benefits, the gut health benefits, and you see even in Middle Eastern cultures, South Asian cultures, a lot more people are being introduced to kefirs, and a lot of people really like the taste. So yeah, the cash position at the end of the first quarter, very solid. We have 12 million, and naturally they're going to use more cash because they're going to investing more into the business. So very good over there. Now the stock-based compensation, it seems like every company's doing this now, but stock-based compensation, $673,000. Free cash flow last 12 months, I think, was around 12 million. 12 million, and you know, so if you consider that, if you say they're doing like 3 million in free cash flow, you're talking 20-ish% of stock-based compensation is from their free cash flow. So, you know, that's kind of high, but like if you look at every other company, they're doing like 25%. I mean, you got like Snowflake and Palantir, which are, I think they're like over 50-60% of their free cash flow stock-based compensation. So I mean, it seems like this is like the new normal. I hate to call it that, but I mean, it's nothing outrageous, I guess. So, you know, you can say 20-25% of their free cash flow is stock-based compensation. Yeah, so if we just look at their property, plant, equipment net, you can see that they do have a lot of, you know, tangible assets in terms of machinery and equipment and office equipment, and you know, so there is a decent amount of goodwill. We don't really know how much exactly that is actually worth. They say it's 12 million, but I mean, who knows what that actually is. But I mean, there's nothing wrong with that because their cash balance is very strong, so I'm not worried. I'm just kind of reiterating the revenues from before. You can see that the gross profit 25.8%, very, very strong. I mean, I'm very impressed. And like if you look before 21.7, if you keep going back, you know, you're gonna see that their gross profit has increased. So leases, nothing major. You know, we got 60 total lease payments of 198,000. So present value 172,000. So very nice. So just taking a look at this company, you know, some of the metrics. They have a solid net income margin, you know, compared to other food products. You know, you can look at other food lines. This is very, very nice. Gross profit margin, net income margin. They're free cash flow positive now, and their gross margins are going up. Their revenues are growing. I mean, now at double digit, but even if you stabilize at high single digits, very nice valuation perspective. You're trading at an EV sales of basically 1, right? Enterprise value is like 165 million. I believe they're doing something similar to that in revenue per year. So, you know, that they're finally producing free cash flow as well. So that's very cheap. Now, obviously, you know, food products are gonna trade more like low single digits EV to sales. So that's something to keep in mind. But I don't think a 1 is justified, especially when they're free cash flow positive and margins are gonna go up, like management has been talking about. So, you know, net of stock-based compensation, you know, it's like a 6-7% free cash flow yield. And if you consider the fact that, I mean, now it's double digits, but if you consider the fact we're probably going to stabilize, I don't think it's an unfair assumption to say until like 2028, 2029, we're going to have high single-digit growth, CAGR, or even mid-single-digit growth. So I think it's a pretty conservative outlook to say that, you know, even without that stock-based compensation, the free cash flow yield plus the growth, we're talking like 13-14% annual return without any multiple expansion. And I think their forward PE is like 13. So I mean, I think you're at this price right now, around $12 a share. I think you should beat the market pretty easily, assuming, you know, things keep going the way they are. So I think the margin of safety is quite nice. And like I just talked about, the P is like 14, 15, and I think it's conservative because margins are improving. Recently, we're getting double-digit revenue. A lot of people are, you know, the market for kefir is expanding like crazy, and it's not. There is competition, but you know, the lower calorie kefirs and this different types of flavors, which not every brand has, is really kind of what people like in the Lifeway products. So, I mean, I think it's very fair for this company to trade at like 1.5 EV times sales, maybe more like 17, 18 times earnings, given the fact that their margins are pretty solid and they're going to keep going up. So, I mean, I don't think 18 times earnings is like unreasonable, maybe even closer to 20 with those gross margins and double-digit revenue growth if it stays up. 20 is very, very fair, I think, you know, so, I mean, this is a great business in my opinion, and I think the valuation is quite nice. I have a position just around $12 a share, maybe a little less, can't remember. But I think if they maintain this growth and margin, this would be great. And if they increase their free cash flow, which I think in the last trailing 12 months was like 12 million, I mean, even net of stock-based compensation, very, very good for this current enterprise value that we have right now. So I really like this business.